Well, good morning. Glad you all came. It means a lot. I appreciate it. Thank you. My name is Steve Griffin with Downstream Energy Group. Today we're going to talk a little bit about overcoming valuation concerns and maximizing your chain's worth. A little about me. Born and raised in Arkansas. My family was in the service station business beginning in the 1950s. What we would call tires, batteries, and accessories. So we had service stations, two-bay service stations. Grew up in that business, wholesale fuel supply, taking care of service stations, hauling fuel. From there, post my education, I went on to investment banking for a period of time and then into commercial banking, combining the knowledge of the capital markets. I was in Chicago and Memphis and different markets for a number of years. After that, I came home, took the petroleum company, and we decided to enter the retail business. This was 1989. So we started in retail. Store number one was Bono, Arkansas, a rural country store. From there, over the next several years, with the knowledge we had in capital markets of how to gather cash kind of early on and put money together when the industry was a little bit behind that curve, we were able to do so. We built stores. We had our own construction company. Of the 70 stores we had when we sold in 2003, we probably built 25 ground up, the rest were acquired. That was quite an experience. We learned an awful lot. After that time frame, I began to enter this business as an energy advisor. There was no plan, there was no business plan. I didn't intend on doing it. It was at the encouragement of Citibank, who were good friends of ours, who said there's a niche in the petroleum industry. The business is going to roll up. This is 2007 or 8. The business is going to begin to roll up and they need advisory services. You have unique qualities, being a former owner-operator and leader in the business, both wholesale and retail, and then the investment banking background. I was confident we would fail. We haven't yet, so we continue on. Now, let's talk a bit about the market, what we're dealing with today. Obviously, there are more buyers than there are sellers. Whenever we bring a transaction or process to the table, if in fact that's a good group of stores or a good company, we are able to bring quite a few buyers to the table. Who are they? National consolidators, regional operators, major oil companies that have JVs that are now getting structured to execute and operate in order to grow and secure the volume. Then you have private equity. Private equity is a unique animal. All of you are encountering them because they call you all the time. And they're very capable financial people. They're very shrewd operators, and they know what they're up to and what they're doing. Now, what does this mean for you? There has never been more demand, I can tell you today, for quality assets. There's a strong need. When a strong portfolio comes to market, the best buyers show up. Now, they don't always show up for every portfolio. I want to be clear on that. But they do show up for the best portfolios. Now let's talk a little bit about the reality of valuation, where that stands today. Look, all of us, admittedly or not, always have a number in our head. What am I worth? And what goes into that? Well, you know you've spent years and years in the business, developing the business. You know what you bought for land. You know what you invested. You know what it's taken. You know the time that it's taken. And you're also constantly reading what comes out in the I might want to call them rag magazines. This guy did that. This guy did this. And much of it's accurate and some of it may not be. But the point is you're gathering information and you're developing a number in your head all the time. Now, what is that? Well, that versus reality. Let's talk about reality. Reality starts right at the top with EBITDA. Now, what is EBITDA? We all hear the acronym. We all probably know the acronym. But that's something the financial markets, look, when I grew up in this business, no one, you think I ever heard the word EBITDA 30 years ago? I heard it in the investment banking business, but I never heard it in the petroleum business. And if you'd said that to my father, he said, what are you talking about, you know? Earnings before income taxes, depreciation, and adjustments. That is true cash flow. Now, in the investment banking business years ago, when we were evaluating assets, we'd call that cash throw. What does that mean? All we cared about is knowing what cash does the business throw off. That's what we're looking for, free cash flow. Now, you hear about closed transactions. Some of that's accurate, some of it's not. So that's putting a number in your head also. You also hear about some of the competition shares this or that with you. Maybe your accountant tells you something. Maybe your attorney tells you something. One of your good friends does. All of this begins to line up. But the real business is based upon EBITDA, true comparable closed transactions, the current buyer competition, who's vying for those assets, and the condition of the business at market. Now, those points I'm bringing to you, all of the group I showed you earlier, particularly the consolidators, major oil joint ventures, and particularly private equity, these guys understand those things. They're looking at them. You need to be completely aware of them if you're considering a sale at any time in the future, now or later. Now, how's the business valued? Well, let's go back to that acronym, EBITDA. So the true cash flow or cash throw times a multiple. That's a number, okay? For the use of this, I think this is fairly realistic. Our team at Downstream Energy Group put this together, and we think this is relatively fair. So let's call the low end of the market where the value trades or where the business trades are at a 4x or 4 multiplier. The top end of that range, it's 7 or 8 or even better than that times that multiplier. So let's talk about that being the market for the moment. Now let's focus on the low end. Unfortunately, if you're priced on the low end, this is why you're priced on the low end. You have deferred maintenance and environmental issues, inconsistent or blended financials, limited inside margin differentiation, market demographics, rural versus urban. What does that mean? It's not that rural stores aren't good. We built our family business on rural stores, okay? And many of the big players in the world today have dominant rural stores that do great. But I'm talking about valuation right now, okay? If your store is at the corner of Main in downtown Indy, or it's outside at the corner of Corn Meets Corn, there's a valuation difference, okay? I'm not talking about EBITDA at the moment, but I'm talking about a lot of time what you're looking at it on the lower end. Lack of real estate control, what does that mean? Fee-owned real estate has greater value than leasehold properties. Leasehold properties trade at a lower multiplier than does fee-owned. Why? Because fee-owned, you control and own it. The destiny is the owner's, right? The end game is the owner's. In a lease, you do have a termination. The important thing behind leases is you have a good initial term and multiple options at fair market rates. Higher multiplier drivers. This is what you hope to be if and when you decide to sell. Clean, well-documented financials, strong inside margins and food program, fee-owned real estate and clear market position. So the market knows who you are. Big box, well, let's talk about that. I'm talking bigger than, as opposed to smaller, adds value. Look, when I grew up, again, it was service stations. So you had a tiny space, you went in, that was it, 2 bays. Then it became you'll remember the Under Island Marketer, little store. All of a sudden we thought we had a convenience store. We were selling tobacco and cigarettes, and that's about it, maybe chips, because it was very small, gas on each sides of that little building. Well, that trades at a low multiple because why? The buyer has limited options to create margin volume inside the store. So a bigger store with a little more square footage, suitable acreage, good ingress, good egress, and even the ability to expand because you don't know who's going to acquire you. They may have a diesel program. You don't know. If you happen to have that amount of property, that increases the value of your overall company. Now, let's talk about how you get there. The drivers, what you want to do to create more value and a greater value in the company long term. Number one, quality of earnings. Look, the quality of earnings are important. If your earnings are like this, that's not any good. And I'm assuring you, these competent, capable buyers weigh that in, and that's called risk, and you're priced down for it. So clear, recurring, normalized earnings or buyer's discount. Number two, inside margin. Fuel's commoditized, let's face it. You could be making 25 cents a margin, 5 cents. You could be making 40 cents, okay? It is what it is. So what do you do to combat that? Well, it's clear. You're fighting on the inside of the 4 walls. Food, coffee, high margin merchandise are real value levers for you. Next, that bigger store, that bigger mix, what you have to offer. Modern facilities. Now look, okay, you don't have to have brand new stores. That's not what I'm suggesting. The key factor is that you're keeping the store competitive. Restrooms, beverage delivery, flooring, gondola, pumps. All of this has to be kept up, modified, renovated, etc. Very, very important to keep this, to be driving the value of the business. Real estate ownership, we spoke of it earlier. Fee-owned real estate is going to drive a higher price than is fee-owned real estate. Number 5, market position. A tight cluster of dominant locations. Okay, when you have a market presence within a region and you are known, Jack and Jill stores are in an area and they connect the dots and they like Jack and Jill coffee, at least in their mind, that's all that matters. Well, they can stop and use you, create a loyal following. Look, if you just said, I like this store in Kansas City, but I like the one in St. Louis, obviously you're going to hurt yourself, particularly when the smart buyers come to the table. That's not going to drive value unless it's some unusually super high volume unit, which we don't run into very often. So that consistent mass makes quite a difference, and it brings the best buyers to the table. Environmental clarity, look, we'll talk about this further on, but environmental clarity is very important. Buyers don't discount known issues. What they discount are unknown issues, and they discount heavily for that. So they need to know what they're buying. The silent discount factors, buyers find every single one of these in due diligence, and they do, because the buyer's smart. Keep in mind, guys, I want to explain one thing to you. You get one chance to do this, and only one when the time comes. You can't mess it up. If you do, it's too bad. Maybe it's first generation, second generation, even third generation, you blew it on. You got to know what you're doing. You got to be very, very careful. They find these things. So what am I really talking about again? Deferred maintenance, environmental. Look, they're going to dig that out. You may be covering it up a little bit with a blanket, but you can't be. You've got to keep the maintenance items up to speed. An annual budget, a plan, an organized group that's focused on the store, independent of your eyes, to tell you what needs to be done on the inside and out of the side of that store. And then you need to build that budget, and you need to keep it competitive. Inconsistent or hard to read financials, that's just got to go, okay? These financials need to be very clear. You need to have a unit level financial per unit that knows what that unit creates and what you're allocating to it for corporate overhead. What G&A, where's that G&A, what for, how come, why? These financials need to be very, very clear and clean. No commingled or numbers in there that aren't directly plugged into that business or that store. Competitive landscape. If buyers found out, look, these big operators, what do? They get bigger. They get bigger and they get bigger. That's the business plan. There's no secret. They tell you that. So let's say, for example, you've got 15 stores in a strategic market that's very important to you. Maybe you only have a total of 20 stores. So 10 or 15 are in that cluster, that direct metro market. The others are on the outskirts of it. Look, if you don't believe when that major player comes to market and says, and makes that announcement, we're coming to this market, we're going to build, we're going to buy, we're going to do these things. What do you think that means to you? Now, what you should be is attentive, listen closely, study, research, determine what this means long term. Am I going to lose volume or what? Well, chances are you are. So the question becomes, what am I worth today? And what's going to happen now if, in fact, that major consolidator does execute their business plan? And why would you assume they would not? You think they're bluffing? No, don't. They're not going to bluff you. They don't have time for that. They don't really care. The point is they have strategic mandates. They have business plans. They're not about you. They're about the corporation, the company, how they grow it and build it. You got to know, how's that going to affect me, and what does it do to my equity and my long-term value? Case study, real and true in my company, Downstream Energy Group. So a number of years ago, someone that we had known for years said, I want to sell the business, it's ready. The two owners were both over 70 years old. They had timed out. They had no succession management. So they both wanted to take their money and go to Florida, okay? They came to us. We did what we always do. We did a valuation. We looked at the business. We came back. Now, I already knew their expectations because I asked for that on the front end. What are your expectations? What do you want? What do you believe? What do you need? Somewhere in that, well, they told me. Our team did that full evaluation. What we determined during that valuation was they were not going to be very close to their expectations. So what we did is stop. We pulled them together. We sat down, we talked to them. We said, look, this is not going to be like you want it to be. Well, what do you mean? Why? Well, thankfully, we have a team that's organized enough to tell them why in specific. So we gave them the list, much of what we talked about, deferred maintenance, environmental, etc., on and on. Well, they looked at it kind of, well, what do you think we ought to do? I said, well, if you got to hit that number, you got to stop, we got to stop, and you got to go to work. We got to build a checklist. We need to be in agreement on it. You need to build a budget, and you need to attack. Well, we agreed that would take 24 to 36 months or something like that. Well, they went to work. They were serious. We worked through that process with them, checking things off, helping them in a review. Yeah, that seems to be right. That should be what you need to do. Yeah, we agree. Once they got there, it took them about 24 months. They got there in a couple of years. We then went to market. We built a confidential information memorandum, invited the best buyers to the table, which it invited on its own the best buyers because of the condition of the assets and where they were. And in doing so, it's a nice story. We actually exceeded their expectations. So that was successful. Now, how do you do that? What does that mean? How do I create a premium company that the premium buyers want to buy? Number one, fresh food and proprietary food service. I can't talk about it enough. I mean, you already know this, okay? When you have a proprietary food program, I'm not saying it's not branded or franchised. It could be easily, but it's repetitive. It brings people back, high margin, good volume. It doesn't go like this in terms of revenue. It's pretty good. It doesn't have to go like this, but it's pretty good, Very important. Premium coffee and beverage programs. I'm not telling you anything you haven't heard before, but you need to make sure they're premium beverage programs. Hot and cold, doesn't matter. They create loyalty, they drive inside volume. I'm telling you, the big buyers look at these things. This is their checklist, okay? Next, well-maintained facilities with minimal deferred CapEx requirements. I don't know if there's anything bigger in the building. Goodness gracious alive. I'm telling you, if they come in, if you think that I really need to put $5 or $6 million in this, but I don't want to do it, and maybe the buyer, they're not going to ask for $5 or $6 million in the discount. They're going to hedge that bet. They're going to know the real cost. They have people that know that. They're going to come in with an $8 million discount on that or some number greater than what you anticipated, and you're going to be furious. But it's only because you allowed that to occur. So if you keep that up, that doesn't happen. Clean, well-documented financials, we talked about. I can't say it enough. They're critical. Empowered management teams, we haven't spoken about that yet, but this is very, very important. We'll talk about it more. What does that look like? Look, let me tell you, the biggest pain we have in these deals is when the big buyer comes in, they're doing their work, and they figure out this thing revolves around the doggone owner. That is not a good thing. That's a negative. They need to see, and we'll talk about it more, that you could leave for 90 days and nothing happens. Now, if they see that, the team's rallied every morning at 8 o'clock, they're waiting on the leader to come in to cheer them forward and tell them what to do, that is a negative, and that's priced in, and that is risk, and that's not going to be good. Now, let me be clear. There are two different buyers out there, okay? Private equity historically is going to need your team. Big box consolidators, they don't need your team, okay? But you need to be prepared because you don't have any idea who the best buyer is going to be. You don't know who that is, right? Management teams, capable, competent people, manager, district managers, whatever it takes, the C-suite, those that oversee this, a COO. This is not, I don't care how many stores you have. You've got to have that management team that can operate without the owner. Fee-owned real estate, say it again. It drives your value up. Premium, that's what the big buyer is looking. Oh, you own the property. He's going to give you a little bit more credit now. Larger facilities, so they have optionality. Here's the thing. The bigger operators have programs. They don't care about your programs. They have their model, right? But the question is, do they have the ability to go in and retrofit your store and execute their model? Well, if they don't, you're not interesting to them. Just be clear on that. There's no fixing it. Now, if they think your spot is so great that they have to renovate it and change it, you're still going to get discounted on that because they got to add 1,000 square foot on to get the program in there. So am I telling you to go build great big stores? No, I'm not telling you that. I'm telling you this is what they look for. That's what drives your value up at the end of the day. Fuel supply agreements. We get this a lot, and people get confused on it. Look, if you're contemplating selling your business in the next 2 or 3 or 4 years, don't go sign a 10 or 15-year supply agreement. Now, why? You think that's good, it strengthens you. Well, at the time that you're exiting, it doesn't strengthen you. Why? Because the buyers that are buying you are bigger than you. I know it's hard to believe, but they have more leverage with the major oil companies or their fuel suppliers than you. So if you've trapped them in a fuel supply agreement, they discount you for it. Okay? You'll pay for it. There is no free money here. But if they have the flexibility, because if they see you're timing out, in a year or 14 months, well, they can swallow that. They can deal with that and then renegotiate their lucrative supply agreement. The big fish. This is another case study within downstream energy, a real story. So we have a seller comes to us several years ago, big operator. This transaction, particularly this time, $150 million to $200 million exit, substantial transaction. Exceptionally well-ran company. Sites perfect, CapEx perfect. Leaseholds that had leaseholds had optimal years on them. Everything was perfect. Accounting, holy cow, I'm thinking like, where did this come from? How fortunate are we? This is fantastic. Valuation was very strong. He was happy with the valuation. He said, that area, that'll work. Now, keep in mind, now we're very focused on the process when we go to process, because the process is designed for a couple of things. Obviously, it's out there to find the best buyer and give you optionality and pit others against each other in order to drive your price up. But in the back of our minds, as the advisor, we're looking for the anomaly. We're looking for the person or a company we hope to find too that you are strategic for. They need to acquire you. What for? Maybe they're up here with a high volume of fuel and convenience stores. Maybe they're down here and you fill the middle. Now you become very, very strategic. And they have economic reasons to pay more. So when and if the net that is cast in order to run your process nets a couple of strategics, now we got a great thing going. Doesn't mean that a regional may not compete and win. It doesn't mean that, but it means that you've got a hot process and you're attempting to catch them. In this process, we did. That's what happened. The bids came in. Best buyers in the country. I mean, these are sharp, competent, and they know their business. All those bids are right here. They were closely clustered together, tight as can be. And then there was this one. Well, that only told us, and we knew that buyer was not stupid. We knew that real well. We knew this was strategic to them, and they wanted it bad. So what do? We do what we always do. We revealed everything to the owner. We made a recommendation to tell them to sharpen their pencil. Second bids are due here soon. We need them in 2 to 3 weeks. What can we do to provide you with more information? Give us your best and final. What happened? All of them went up, including the guy who's up here. Now he's up here. What did that mean? Well, it's clear and obvious. We had a defined clear winner. We announced it. We told those that lost, and the one that won it, won. It far exceeded the expectations of the valuation, because the valuation is logical, reasonable, rational, based on other trades. What I'm saying to you is, when the process is run correctly, oftentimes it nets a person, company, entity that has a strategic, motivated reason to be in that market, and their economics will drive them to pay more. When is the right time? Now, that quote's important because I want you to remember this. I think this is very important. The best time to sell is when your business is ready, not when the market is hot. So don't sit around and study the market being hot. Don't focus on the market. Focus on preparation. Readiness is what you're focused on today. Now, sure, okay, you could say today, what's the tax policy like? Well, it happens to be beneficial today, right? Now that's going to change. It will in time. Bonus depreciation's good. Individual tax rates, et cetera. There's a window. These provisions are come and go, and sometimes they're advantageous, sometimes they're not. But I get too many people focused on that. And I want to tell you, that's what many are focused on. That's not the focus. Second, strong margins create hidden cost. Record profitability. People, I hear this, we're making so much money we couldn't even consider selling. Well, when do you think the time to sell is? Do you think it's when you're making the lowest amount of money? I mean, seriously. If EBITDA is going down, the trend here, and you go, well, holy cow, we need to get out of this business. Well, you're making the job hard on the advisor now, because these buyers are very smart. They whip you to death on declining earnings, declining revenue. They beat you. It's the hardest negotiation in the world. So don't think that works in your favor. It works against you. The preparation window is real. Meaningful improvements. I'm telling you that 12 to 24 months. If you're focused or contemplating you want to sell, you need to focus on the next 12 to 24 months in order to get ready to do so. Succession. The people that the companies that listen to the sermon I'm offering here, the tutorial, whichever you might want to call it, okay, are the ones that are prepared and ready, and they have options. They have various different buyers. They have a lot of flexibility. They have choices and decisions to make. They're not forced into the corner. So it gives you optionality. 5 questions every owner must answer. These are very important. Do you know what your business would sell for today based on current market comparables? Not what you hope or assume. Now, if you answer that question to yourself, think that through carefully. I think I would sell, that's not the right answer, okay? You need to know. Could a buyer understand and verify your earnings within 30 days of due diligence without you interpreting their numbers? Look, if they can't look at your financials and understand them right away, you need to go back and figure this out with your accountant, your internal people, and get these things simplified. If you stepped away tomorrow, would the business continue to run effectively for 90 days? Big issue. You need to ask yourself that. If that's, you got to be back. I'm promising you, the tests that the buyers do know these things. You don't have to tell them. They find it out. They're very, very good at what they do. And you need to be able to walk away from that business, get sick, whatever, and no one worry about the day-to-day operations and the continued success of your company. Do you have at least one high margin, just one differentiated product inside category that drives regular customer frequency? Ask yourself, do I make myself a little bit unique? If I don't, well, why don't I? Talk to your people. Why aren't we unique? Are we just like Jack in the Box? Are we just like this? We're just like that? Well, why? Look, you want to identify what the customer needs are for that store, and that creates return business. When you do that, the buyer sees that. He knows that you've done so and you've created value within that business because of that differentiated product that drives and brings the customer to you. These details are critically important. Now, do you have a clear picture of any deferred capital, environmental, or compliance issues, and you have a plan for them? That plan's important. Buyers are careful. They'll come to the table and in that negotiation with you during diligence, go, oh, by the way, do you happen to have a deferred maintenance program? No. Well, that's not strength. Check, the price is going down right now. Trust me. You need to say, well, by the way, I do. Matter of fact, we'll be happy to share that with you. Here's what we see the business needs in it the next 24 months. Oh, check, the price is going up right now. Very important. The preparation timeline. This is much longer than people think. And this is not something go, oh, goodness gracious, dad's not feeling well. Mom don't want to, mom said we got to sell the business. That's not a good thing. If you're not prepared, that's a bad thing, okay? So what do we call today? Our team at Downstream Energy, the deal team, calls now 1 to 3 months. What do they want to see in the next 1 to 3 months? So they want to see you get an honest valuation assessment. Now, let's talk about the honest valuation assessment. Look, you may think I need an appraiser. I need to talk to my accountant. I need to get a business evaluator. No, you need to find an industry-specific, somebody that operates within this sector, gas and convenience and wholesale fuel distribution exclusively, and has a team and a reputation that's built around it year after year, repeating good behavior, executing deals to value your business. This needs to be very independent, very at arm's length. Those are the only people that really know the nuances of this business and where it trades. Am I saying the other people are not worthy? I'm just saying you can't count on that as well. You need something you can hang your hat on, share with your board of directors, share with your family members that really give you a true valuation. There are plenty out there. I say there are plenty. There are only a handful of very competent, capable companies in the downstream energy arena that can value your company. Go find them. Check them out. Make sure they're capable of it. Now, what are you doing to the key person risk also? Key person risk, this is another big issue. If in fact the private equity company needs your C-suite or your management team, if you've got a person that's timing out in age, that's a problem, okay? Because if they needed them, they're weighing that in. They need to see a seamless transaction. So the key people that might go with that transaction need to be in position, ready to go. Hopefully they're going to get a great offer so that they're excited about moving forward anyway. Key people, critical. Start environmental audit tomorrow. I don't care. Make sure you're in compliance both federally and with the state. Make sure you have a third party that's very competent and capable, that knows what to do. You're going to have leaks, you're going to have breaks, you're going to have spills if you're in the petroleum business. And when you do, you want to clean them up as per the correct contractor and receive what? A no further action letter and move on. Now, that 4 to 18 months, we call it prepare a Downstream Energy Group. Clean up financials, build management structure, resolve environmental issues, invest in inside margin. That's what we're going to be encouraging you to do. That's what we encouraged the gentleman, the company I spoke to earlier on. That's what we had him do for 24 months, this exact timeline. What do we call ready? Well, that's 18 to 24 months. You're getting pretty ready to go. Audited or reviewed financials. I'm not advocating you all have to have audited financials. Does it help? Well, look, if you have the size, capacity, and you have the wherewithal to do it, yes, it's very important. Let me be clear with you. The consolidators, the bigger buyers are really happy to see an audited financial. It takes a load off of them. Private equities gets squeamish about it. Because why? Because in private equity, they're responsible to the investors. In order to grab the money, the $100 million they're going to invest in the gas and convenience business, or $1 billion, whatever the number is, they have to do a quality of earnings report. That's painful. We go through them all the time. They hurt, okay? Well, they have to do it because you don't have an audited financial. So there's a time and place to have them. Is it for you? You need to check and look. Talk to your outside accountant. Talk about preparation and being ready for that. At minimum, have reviewed financials. Management team proven, they're bulletproof. They're A-OK. I can step away. Anybody buying this company, boom, they're going to see that they're the best. Business, again, runs without you. It's a must. Market, we're ready to go. 24 to 36 months, we're ready to go to market. What does that look like? You need to choose your M&A advisor. Look, if you attempt this on your own, good luck, okay? Good luck. And if you're happy with it, I guess it doesn't matter at the end of the day, right? But what we see time and time and time again, someone's approached by a buyer, big buyer, capable buyer, they engage, and you get beat to death during that diligence because you have no idea what to expect. You think you do, you've read it, you've seen it, and you, by the way, I've bought property all my life. I know title work, it's not a big deal, environmental, no. Whole new ball game at the time of exit. And again, you are outgunned, okay? You're coming with pop gun, and the buyer's got twin pistols, and he is a quick draw. So you're gonna get shot up. You're gonna get a lot of bullet holes in you, and you need to be ready for it. Always find a competent, capable specialist in this industry to guide the process. They're worth their fee, and they'll make you more money than you would have made on your own. Process, if you don't run a competitive process, you never know where you are. Look, we represent buyers. And when my hat's turned the other way and we're representing a buyer, no, we don't want a competitive process. We want to be able to corner you. We want to be able to negotiate this price as low as we possibly can. That's the fiduciary mandatory responsibility in the contract. But when you're selling this business, you don't want that to happen. You want to, you think you know what it's worth. And, I gave you my example earlier, the big fish. If we hadn't have ran that, as a matter of fact, in that instance, the winning party that paid the way above everybody else bid wasn't even on the first invitation list. We didn't even see them. It was like, what are you talking about, But in a second run through, we go, what about, I don't think they'll buy this space. They're not investing in it. It's probably a waste. Let's call them anyway. And voila. So the competitive process is 75% art, in my opinion, 25% science, okay? That's why you need a capable, competent, engaged advisor to guide you through it. But he or she absolutely needs to be engaging a competitive process. Multiple buyers at the table, the more qualified buyers, not everybody, not tire kickers, qualified buyers, the better. Close at maximum value. That is the sole objective at the end of the day. Now, questions that I get and the company gets all the time, in email, on the website, phone calls, etc. Let's talk about it. How do I even start finding out what my business is worth? Get a professional opinion, unbiased, third party. An M&A expert within the gas and convenience and wholesale petroleum business. That's who you want to tell you where you will trade. Now, it's not a number, it's a range always. Competent, capable people are not going to come and go, you're going to trade for X. No, they're going to come in and say, look, on the low end, we see this. On the high end, we see this, and here's why, and they're going to tell you all the assumptions and what they used in the model, and it's overwhelming, but it's critically important. That intel establishes that range. That's the first thing you want to do. And I want to discourage you. Look, I was negotiating on behalf of Shell some time back on a transaction. Goldman Sachs was the opponent. Okay, you think, holy cow, they're the biggest, smartest, and they are big and smart, and they're a little bit scary. It's hard to even get in the building. However, I had the Shell letter, so the doors opened. We went right in at that point. There were the most experienced, mature investment bankers in the world in that room, and I was a little overwhelmed. I was alone as the advisor on this little Shell transaction. And I go, why the presence? They said, well, we looked at your bio. You know more about petroleum business than any of us know combined. So understand, what did that say? We're the specialists, not we, those in the industry, our company and our competitors' companies. They're the experts you need to rely on because they can guide you best. EBITDA multiples. We hear this all the time. What's a realistic EBITDA multiple for a 20 to 30 store chain right now? Maybe it's 10 to 15 stores, maybe it's 50 to 100 stores. Well, I can't answer that question. I can give you a range like I showed you a while ago because it depends on a number of things, and it's not fair for any kind of advisor in this space to answer that question flat-footed. It depends upon geography. It depends on a number of things, the quality of your assets, on and on, all the things that we just discussed. Now, in that valuation, that will hammer that out. That'll answer that question. But if someone quickly tells you, well, you know, you're an 8, you're a 7, oh, you're a 10, throw that out the window. Go find your advisor, let them do the job, and then you'll establish a rational range that you can share with your family, your board of directors, etc. My accountant says my business is worth X. Why should I believe an M&A advisor over my own accountant? Well, you know, I mean, again, you don't go to the dentist for heart surgery, okay? It's the whole story. I mean, goodness gracious. You need a specialist there. I'm not hammering on your accountant. The accountant is critically important. We will be engaged with that accountant, asking for information all the way through this process. But that's not what the accountant does. You need to rely upon the advice of an independent third party that executes within that arena on a consistent basis. Share that information with your accountant. If they are the accountant they should be, they're going to really find that the information you give them very interesting. Unsolicited offers. This happens as much as anything to us. So we got an unsolicited offer last year that we turned down. How do we know we made the right call? I don't know. My answer is, I don't know. You may have. I don't know that. We don't know what your company, you know, unless you have that valuation. Now, if you've had that valuation, let's say in the last year or two, well, you got a pretty good handle on what your business is worth with some modified changes. So you yourself can make that judgment call. If you believe in the valuation you have, you'll know at that point. So the point I'm making is you don't know what you don't know. And the evaluation is the point of beginning to understand the value of your business. And it's critically important. Look, companies like ours, we don't make money, we don't charge you a fee to value your business. We're M&A transactional people. We know that we are good fiduciaries and we're responsible to the parties out there in the market. That business comes back in time. Any of the advisors in our market will do the same thing. Pick the one you like, get them to do the valuation so you're aware. Succession planning. What if I want to sell, but my kids might want to take it over someday? What do you want me to tell you? What do you want me to tell you? Okay? Look, these are two totally independent decisions. I know my mother and dad started the business. I was generation 2. That was the 3rd generation. So we're very emotional. We're very personal about all of this, you know? We all were. My mother was particularly, and she'd made the decisions there. I want to be clear on that. So what did we do? Separate them. Separate this decision. Get an independent third-party valuation. Share that with your family. You won't believe how many times we've changed the emotional stage with families and that emotion. Maybe you had a daughter that wanted to keep the business. We're dealing with a situation like this right now. I've already met with the board twice, and it has been such a struggle and real emotional. The family ranges from 79 down to 26, all on the board. And that middle is very vocal, okay? And actually, they're not that involved in the business, quite frankly. They're not day-to-day operators, but they have an opinion. and they're very strong. And it, again, is very emotional. We've had this forever. My grandpa started it. My name is on that sign. And there's just a lot of ego involved in this, and you can't get away from it. We suffer from it too. You know, when you saw Griffin Express, man, that made me feel great. When you talk about selling it, I'm like, wait a minute, you know. So but that's not the process. You need to take a look at the valuation. You need to take a look at the family dynamics. You need to go openly to the board, share this and say, here's where we are. That tends to level the conversation out, and it starts a new conversation. Transaction timeline. How long does it take a transaction typically take from start to finish? Well, this is something that's important. You know, if you're prepared, 6 to 12 months usually, somewhere in that range, that's going to be a pretty good timeline. 6 months is really fast, okay? Really fast. Rarely do we ever have a transaction take place in 6 months, but we have had that occur. Things just clicked. It was unusual. Do they take 2 years sometimes? Yeah, they do, because you're not prepared, you know, and we're having to fix and stop and and negotiate. And then what happens is the buyer during diligence finds a problem that stops them. They quit. Oh my goodness gracious, you know, we didn't know the tanks were that old. You didn't tell me that. Oh goodness, you know, this building, this HVAC system we found 5 that don't work. That's $150,000. On and on and on. So again, you've got to absolutely prepare before you go to market. And if you do, 6 to 12 months is a rational timeline. Confidentiality. Should I tell my employees or managers I'm considering a sale? Generally, no. That would be foolish, absolutely silly, and we'd encourage you not to do it. Look, any kind of early or premature disclosure is an error in judgment, okay? Be a responsible leader. I know you've known that person for 30 years or this person for 20 years, and I understand that. But where is your responsibility? Is it to the board of directors and the shareholders where it should be, or is it to some emotional feeling that I just should tell Patty about this? Look, ask yourself who you are, who you're accountable to, who you're responsible to, because you're after one thing at this point: maximum exit value for the shareholders. And if you deviate from that, you're making a tragic mistake. So, your advisor is going to guide you during this process. Absolutely, the revelation that you're selling is going to come out. But with a competent, capable advisory group that does this repetitively, they can share with you and get you comfortable with when that time comes, because it has to come and it will inevitably come out. And look, I want to clear the air on the confidentiality. You know, people are saying, well, it's going to get out. Look, we repeat this forever. We've never had a transaction not close over confidentiality. Never. Now, have we had breaches that we've had to deal with? Yes. Have we had it implode and kill the deal and the whole company walk out? No. Employees need a paycheck. They're not leaving you in 15 minutes. It's irrational thought that they're going to do that. So all that just to say, even in the situations where it was fumbled and messed up, things still move forward, but keeping a lid on it and following the advice of your advisory group is critical. Always do it. Evaluating advisors. I want to encourage you to, if you're thinking about, well, first off, you're saying, I need to get a valuation. You know, Steve's persuaded me it's the right thing to do. Then you need to go forward and look closely. You can go forward and find the best-in-class advisors, study them, find out who they are, find out what their bios are about, find out the history of the company. What deals have they done in the last 2 years, 3 years, 5 years? Make them show you that, because they can share with you unique, unusual structures, not just, if they are only telling you this is the way it is, this is the way it is, you need to back up a little bit, because that's, in M&A, nothing's the way it is. You've got to be creative, competent, capable. You've got to be able to make changes and do modifications. And you need to find out that they've done that and they're capable. So do your due diligence, select the advisor, get the valuation done. Then don't worry about tomorrow. Care for today. Don't worry about tomorrow. Get the valuation done. Once the valuation is done, you're able to share with whomever you need to, your family, your shareholders, whoever it is, board of directors, this is what they say. And you'll need to have your advisor in, because half those people are going to have a bunch of questions. Well, I don't know why you did, why we're not worth 8.5 times. Okay, you need that question answered. So vet it thoroughly. Now you're going to create, let me tell you what happens then. A whole new mindset starts. A whole new way of thinking. Now the board, the decision makers are more open-minded. That myopic tunnel vision kind of goes away. And it's good for the business even if you stay in business forever, because they're now looking at other things. What drove this valuation? Now they go look at the competitor. They should have been doing it all the way along. Okay? So it cleans up execution. Now, I didn't see that coming. We started doing these valuations, and the guy goes, well, that's pretty cool. That's pretty good. Well, they didn't do anything. But then we came back, and they'd been going to work. I'm like, well, you showed me over here, and I thought we were worth X, and you told us we're weak here. It was a great execution, a great practice, a really good process. I encourage you to do that, and I encourage you to find the evaluator. I encourage you to find the advisory group. The advisory group offers valuation as an augmentation of their business, and select them and move forward. Now, let's talk a bit about when you leave. I'm going to give you something you can take home with you. We're going to have questions. Anybody wants to ask a question, it's fine. But when you leave the room, this is very important, okay? This just take this home with you, okay? This is seller readiness self-assessment. If you fill this out, it is so revealing. It is just, you're gonna really find it cool. I mean, when we put this together, I just couldn't get enough of it. I just think this is fabulous because it allows you to now focus on where I need to be focused. Or it may have created a question. You're not sure how to rank yourself. Am I 1, 2, 3, or 5? I'm not sure about that. It's not lengthy, but it's high priority, and it'll tell you what's very, very important. So be sure when you leave to grab one of those. Well, that's about all I have to say, and I'd love to open it. If anyone has a question, here's a mic, an open mic. So unless you're strong and loud, please pose your question. We'd love to answer it. I'd love to try.
You talk about the financing to the bank environment. Did that brought about
Yes. So talking about the banking environment?
Well, just like for buyers, are they getting financing? Is it the number of turns that banks will do? Is it how much debt will they put on? Does that drive
Okay. This is a good question. So in every process that we run today, we confirm that each buyer in the bid pool has the ability to close for cash. Now they may be getting that through a fund. It may be through a bank. It may be they have the cash in the bank. The consolidators are just typically pulling from cash, or you have no idea where they're pulling from, but they have the money. So it's very important. If they throw in an LOI, letter of intent, that has a financing contingency, we tell them in advance, don't send an LOI in with a financing contingency, you're out. Now, years ago, we couldn't do that. We didn't have the organized buyer group that we have today, but we do today. And you can't take the time. And I want to discourage you when you're getting ready to sell that business. If you receive from any advisor, if they're bringing you letters of intent, contingent financing, you need to be very concerned about that. That's not the deal you're looking for at all. And today, again, if you're prepared and ready, you don't need any financing contingencies. You can find cash buyers that'll pay you. I hope that answers. Is that good?
How about, you talk about how hot the market is now. What threats do you see in 3, 5+ years?
Well, the threats are the best in class. They're very organized. They have a lot of money. They have great programs, and they tend on capturing the market share. They have a strategic, organized plan to execute. You need to be aware of that. The competition in the gas convenience store, we were the dirtiest business in the world. When I went to KFC in 1995, I thought, man, I can sell them. We're going to put Kentucky Fried Chicken in our stores. We're so good. I met Mr. Novak, the CEO. I don't know how I got in his office. And I said, hey, Mr. Novak, we got 25 convenience stores. And he just went like this. I go, man, I could put KFC in all of them. He goes, are you kidding me? You're in the gas business. You people, there's no way I'm putting my program in your store. He said, I can't stand it. That won't happen while I'm here. Well, it hurt my feelings like crazy. So I called him back and I said, well, how do I ever, he said, look, let me tell you what, I don't want to talk to you unless you want to be a franchisee of KFC and Taco Bell. 99 when they merged. And I said, well, I'll do that. So we ended up making an acquisition. We bought KFCs. We proved ourselves. We worked. And then we had like 8 or 9, okay? And in doing that, we got this great food group that we didn't know anything about making sandwiches or chicken or anything. and we were able to mold them into our petroleum company. We got good. We opened the door with KFC. We opened the door with the food programs. It made a big, big difference, and that created value. Now, am I tracking on the answer to your question at all?
Wait a minute, like what as if people are ready to sell?
Okay, so, yeah.
What should they be? What's the risk for waiting?
Oh, it's a great risk. The competition is going to be stiffer and stronger and better. All we see in this consolidation is better. Okay? Now, margins have over the last 10 or 15 years are far better because you've cleared out a lot of the lightweights. And these are very smart people running these businesses, and they're here to make money. They're not here to fight you. That's not their objective. Their business here, they will fight, and they have the deep pockets, and you don't want to challenge them. I see it getting fiercer, tougher, rougher, better. When they announce they're coming in and you don't take that seriously, that is a tragic mistake. You need to defend your turf. So in doing so, you ask yourself, how do I do it? And if you in that process can't come up with, look at what they're going to offer you. Look at what they're going to offer in their stores. Can you fight against that? You could lose equity in this deal. And we have clients losing equity. We have clients that I get on the podium and say, look, so-and-so's announced they're coming. You're worth X today. The man told me lately, he goes, I have nothing to worry about. I have $25 million in the bank. I said, gotcha. I understand that. That's a great number. I'm impressed, and you've accomplished a lot. Now, let's just talk about the consolidators that just announced. And let's take a look at their balance sheet real quick in comparison. Well, it's no comparison. So let me ask you this. If they come in and deploy those funds to do what they're going to do, I feel confident you're going to lose revenue and margin because they got to get the volume somewhere. Where are they going to get it? There's no more people. They're going to get it from you. Now, what happens then in 5 years? You may be worth less. And let's say you say, I'm going to take that $25 million and defend myself. Hold it before you spend the $25 million. Let's look at this real close. Because again, you could put the $25 million in, you're worth $150 million today, but guess what? After that trend is going to be just like this, what I was talking about. And they beat you to death when you're selling. And again, what you've done, you've thrown the $25 million away and you've sold, you lost equity. So you need to be very careful and attentive. And don't fight a fight you can't win. Be smart about it. There's a time to buy and there's a time to sell. And we're agnostic. So we don't care if you're building or buying or selling because we work both sides. We help people buy their assets. We help people sell their assets. But we do a lot of study valuations like this to tell them what could be expected in that market. Any other questions? Yes?
Good line about store size and small stores along the way. I have a question about for the rural versus urban environments, the small stores survive and we have to change our 2,000 square foot stores to 3,500.
Well, that's up to you. Rural markets have a tendency not to get a lot of competition. I used to be in Waldenburg, Arkansas, Bono, Arkansas, Fisher, Arkansas, had no competition. Okay? So we just maxed out at what we could max out with. Now, if competition, then if somebody showed up, now I got another convenience store in this little bitty town, a whole new ball game, right? But again, if you're constructing, build enough adequate space for optionality for not just the buyer, but for you to offer options, because you may not sell. And you need the options to offer various different products all the time. Now, I will tell you, you are limited without question in small stores. What happens with the consolidators, they buy everything, and then they call people like us and go, hey, I got a bunch of old, worn-out stores, sell them all for us. They don't have any value. And they sell at a very low multiple because there's no optionality there. And the best in class don't show up for those because the best in class have interior programs that they're offering, and they can't execute them. Yes, sir. Yes, sir, please, go ahead.
Talk a little bit about zeros, live tickets, and shining. We were locked in as we started. Just curious your thoughts, how important or not is branding, fuel branding, equating that. Second question about the world, on the next sort of EBITDA as a valuation, tool. You're talking gross margin, percent things on a multiple of gross margin, some for EBITDA, and also real estate value. And different. How do you into those different metrics and try on one primary valuation project.
Okay, contracts. Let's talk about fuel contracts first. Yeah, there's absolutely a reason and time and place for branded fuel contracts. I mean, there's no question. There's some demographics and geography that the majors can just dominate with their brand. And I would never discourage someone not to brand in that market. There's real reasons. There's also reasons to not brand in certain markets. Depends upon, again, the geography, fuel supply options, et cetera. Again, if you have limited options, particularly on an unbranded basis, you better be extremely careful going unbranded, because the most important thing is that fuel supply. You go out and run out of fuel, got a problem. And we've seen it with COVID. We've seen it with wars. Contracts are important. Supply agreements are very important. And I never encourage anybody to operate without a supply agreement. There are plenty of people that do, and they buy on the open spot, and they're rock and roll cowboys. Okay, but and if it works, it works. But branded contracts, you know, we work for the unbranded, we work for the branded, and we get to see behind the curtain. There are absolute reasons for carrying a brand in many markets, and you should know your market, is what I would say to you. Know your options in that market. Maybe a little mix. Now, that answers that question. I'll move on to valuation and, you know, gross margin, EBITDA, what you're talking about. Look, the industry, you may be measuring your business on gross margin. The industry is not. They're not. The best-in-class buyers come to the table, they're going to immediately do what I've just showed you. They're going straight to EBITDA. I don't care what you got, okay? They need to, you know, you may say, well, my gross margin on X, Y, and Z. They go, oh, that's fantastic. You know, we're looking for cash flow. So they really want to take a look at your cost of goods, your retail, your expenses to operate, and what's that throwing off? That's what they're after. Recurring EBITDA is the number to keep, the term to keep in your mind. What's my recurring EBITDA? That's what the buyer buys. He buys recurring EBITDA. So they prove in their analyses, you've proven it, you want them to confirm what you already know. Now, if they adjust it, well, you didn't know what you knew, okay? Because EBITDA is very clear, okay? It's very direct. So if you know what that number looks like, that true cash flow or cash throw EBITDA, that's what they're looking at. Why? Every consolidator, every private equity, major oil, regionals are accountable for the utilization of cash. ROI, maybe they're using, who knows what the metrics is for the return, but they are accountable. The universal standard is EBITDA in M&A and buying and selling. So don't get away from that, because if you do, you're only fooling yourself. Because when you get ready to trade the asset back in or sell it or exit a part of it, EBITDA will be the moving piece. Anything else?
Also, EBITDA versus the also trying to maintain the real estate value.
Okay, look, you may say, and boy, we used to hear this a whole lot. Oh man, I know it. I might sell for 8 times, but you know what? That piece of property over there is fabulous. Won't they give me more value? We don't find that. We just never find that. Look, it may be dialed in and it's unknown. You're not going to know it. Now, I'm not going to tell you that in the buyers sitting there at committee going, you know, we're at a 9, we love this cash flow, and that someone on that committee is not going to say, they got great assets, man, and they're willing to push it a little bit more. But the business is tracked and priced. They're not going to. You're not going to get anywhere by going, okay, I know I'm worth an 8, but I got the best property, so doesn't that drive X or that Y? No, it's cash flow, because they're accountable for their turn. They can't tell their investor on the back end or the stock market, if they're publicly traded, oh, well, we paid up for it because it's got better real estate. You get fired tomorrow? No, it's all about return. It's all about cash flow. So keep that in mind. Otherwise, you're fooling yourself at the end of the day.
If I real estate's worth more in my business, I should just sell it.
Absolutely. Absolutely. And we run into that in Miami all the time. You can't put a gas station back in. Are you kidding me? You know what, $5 million for the corner. Well, you know, and it hadn't built yet, and it cost another $5 million. So stuff like that. Yes, sir, please.
Hey, great job. Very comprehensive. So
Thank you.
I was wondering about financials in the recasting of them. I mean, our G&A is different than their G&A.
Okay.
What should be included and not included?
Yeah, good question.
When you give that information to them, and then you know, I mean, we're far enough from COVID, but you know, our gasoline gross margins vary. And, margins were great, volumes down, whatever. Well, now margins are different.
Yeah.
How do they look at your historical 3-year, 5-year look at that? Then how do they look at that margin going forward when they project their numbers? And then, I was wondering about the variance, in a leasehold property versus a fee simple. What kind of discount? I mean, let's just say on a leasehold, you have big terms.
Good.
They end up going out and selling it anyways. So what kind of discount are you getting if you just don't get the value and sell it to a fee simple? You have a relatively market fair rent versus a leasehold.
Good question. All right, let's back up. Let's first talk about the question as it relates to your financial statement. Okay, look, don't be worried about your G&A. It is what your G&A is, okay? Now, what do the buyers really care about? Depends on who the buyer is. But your advisor is going to lay everything out there. Look, if it's a major consolidator that doesn't need anything to do with your G&A at all, well, they're going to eliminate it anyway, right? They're looking for store level recurring EBITDA. What's it take to run that store? What's it going to throw off? And that's what the bigger buyers really want to see. Now, private equity, no. Private equity may go, this is a platform acquisition. I got to have this deal. So I can't do that. I've got to have the G&A. So that G&A is important. So that allocation, the accounting is critical. So you should be allocating G&A appropriately throughout the financial statement. They need to see it. Look, if it's Casey's buying the deal, they're going to immediately back that out. They don't care. We have a 2-minute conversation. They're looking at store level, okay? Now, again, if it's Fruition Capital, they're buying tomorrow, they don't have a team for that. And they're basically going to take everybody but you, okay? So then they want to see, then they're going to study that C-suite and see that they're competent and capable and that they have a history and they're going to be here and they've done a great job. And how are those expenses spread out over general administration? So, clean, accurate financials is all you should worry about. No, the adjustments are done by your advisor, knowing who the player is. Again, in the final bid, if Casey's bidding, your advisor is going to modify that. You're going to confirm it is accurate. He's going to pull G&A out and show them store level. Now, if it's Fruition over here buying, your advisor is going to know it. He's going to have all that G&A in there that's necessary, extracting you and other personal expenses that might be there, right? There you go. So accuracy. Worry about what you're doing today and making sure it's accurate and allocable appropriately, and then go on and move on. No commingled, nothing in there that doesn't belong in there at all. And the buyers love that. You get premium price for clean financials. Premium price. It takes risk out. And see, if you have to clean them up during the negotiation, they're weighing that. They're going to, what else did you forget? I see it all the time. They go, and they'll say to us, they won't say to you, they don't know what their financials were. They've already adjusted them 3 times since we engaged. Well, traditionally, we don't let that happen, right? We've tested the financials exceedingly well before we go to market in the first place. But if you just want clean, good financials, get with your external accountant, internal accountant, and say, I want them true. I want them honest, and nothing in here doesn't belong. Does that help you, I think? Okay. Any other questions at all? Thank you for coming. I appreciate it. If you want to talk more to us, we're at 307 Downstream Energy Group's booth. You're welcome to drop by. I'm going to hang out there and be happy to talk to you one-on-one. Thanks for coming today. I appreciate it. Thank you.